So, you're curious about options? Perfect. You are in exactly the right spot. Today, we're going to break down one of the absolute fundamentals, the put option. We'll get into what it is, how you can make money with it, and yeah, just as important, how you can lose money with it. Let's dive right in. But first, let me just ask you this one simple question. I mean, we all get how to make money when a stock price goes up, right? But what if you could actually make a profit when a stock price goes down? That's the whole idea we're going to unpack today, and believe me, put options are the key.
To really get a handle on this, we're going to strip away all the confusing Wall Street jargon and just start from square one. Let's not even think of this as some complex financial thing. Let's just think of it as a simple deal between two people. Okay, so here it is. The formal, textbook definition. And I know, it's a bit of a mouthful, right? But not the obligation, underlying security, don't even worry about it. That underlying security part, that just means the stock. At its heart, this whole concept is way, way simpler.
So yeah, let's just forget all those fancy terms for a second. A put option is really just an agreement. It's a contract between two people. And for this little explainer here, let's just say it's a deal between you and me.
So in this deal, you're the buyer. You pay me a small fee, we call that a premium, and in exchange, you get the right to sell a stock to me at a price we agree on today. Now I'm the seller, I get to collect that fee from you, and in return, I'm making a promise to buy that stock from you at our agreed price, but only if you decide you want to sell it. That's it. That's the whole agreement we're going to build on.
All right, theory is one thing, but let's be real. The best way to understand this stuff is to just walk through an actual trade. Let's put some real numbers on the board and see how it works.
So here are the terms of our deal. The stock is Dave & Buster's, and right now it's trading for about $45 a share. You are buying a put option that gives you the right to sell it for $40 a share, and you can do that anytime in the next month. Now the cost for that right, the premium, is 45 cents per share. Let's keep these numbers locked in our heads as we see how this thing plays out. Now, looking at this, you're probably scratching your head a little bit. Wait, why would I ever pay for the right to sell a $45 stock for only $40? I'm already losing money. And you know what? You're absolutely right. You wouldn't do it today. You're making a bet on what's going to happen tomorrow. So here's how you win. Let's imagine the stock just tanks. It falls all the way down to $30. All of a sudden, your contract is like a golden ticket. You can go out on the open market, buy shares for $30, and then immediately turn around and use your option to force me to buy them from you for our agreed-upon price of $40. That's a $10 profit on every single share. You subtract your initial 45-cent cost, and you've netted $9.55. On a tiny 45-cent investment, that's a huge, huge return.
But, of course, trades don't always go the way we hope they will. For every potential reward out there, there's always a risk. So what happens if your bet that the stock was going to fall was just wrong? Well, let's imagine the stock price doesn't crash. Maybe it just stays flat, or maybe it drops just a little bit, down to, say, $41. In that case, your contract is basically useless. I mean, why would you ever use your right to sell it to me for $40 when you could just sell it on the open market for $41? You wouldn't. So the contract just expires, and that 45 cents per share you paid me, it's gone. It was a losing bet, plain and simple. So we've got the basic win-loss scenario down. But in the real world, you have choices. Let's look at the two main dials you can adjust that totally change the cost and the strategy of your trade: time and price.
Let's start with the first dial, time. I mean, which of these sounds like a better deal for you? The right to sell your stock at $40 within 1 month or within 5 months? It's a no-brainer, right? 5 months is way better. It gives the stock so much more time to make the big move you're betting on. And because it's a better deal, well, it's going to cost you significantly more upfront.
So the really crucial thing to get here is this. Time literally equals money in the world of options. The more time you have on the clock, the higher the probability that your trade could work out, and you have to pay up for that privilege.
All right, now for the second dial, the strike price. That's the price you get to sell at. Just look at the difference in cost here. A contract that lets you sell at $35 is super cheap. Our original $40 strike costs 45 cents, but a contract that lets you sell at $45, which is the stock's current price, that's way more expensive at $1.90.
And it makes perfect sense when you think about it, right? A higher strike price is a much better deal for you, the buyer. It means the stock doesn't have to fall nearly as far for you to start making a profit. And because it's a better deal with a higher chance of paying out, the market is going to charge you more for it right from the start.
Okay, we have totally nailed the theory.
Now let's get into the practical, nitty-gritty details, the stuff you absolutely have to know before you ever think about placing a trade. This right here is probably the single most important number in all of options trading. Every standard options contract, doesn't matter if it's a put or a call, it represents 100 shares of the stock. Not 100.
So when you see that price of, say, 45 cents, that is the price per share. To get your actual total cost for one single contract, you have to multiply by 100. So our 45-cent premium actually means you're paying $45 to buy that one put option contract. This is such a critical piece of math to remember.
Now you might be thinking, hold on a second. If the stock drops to 30 bucks, do I need to have $3,000 sitting around to buy 100 shares just so I can sell them to you? And the great news is, nope, not at all. In the real world, almost nobody does that. There's a much, much simpler way. Instead of actually exercising the option, you can just trade the contract itself. So you bought it for $45. When the stock plummets to 30, your right to sell at 40 is suddenly incredibly valuable. Because of that, the price of the contract itself just skyrockets, maybe to $10 a share. You can just sell that contract to some other trader for its new price of $1,000. You were in for $45, you're out for $1,000, and you never had to touch a single share of the stock.
So this all boils down to two really important takeaways. First, options give you massive leverage. That small $45 investment can explode into $1,000. But second, they come with high risk. If you are wrong, your investment can go straight to zero. And that's a key point. Your risk is defined. You can't lose a penny more than that initial 45 bucks. And that is a major difference from other ways of betting against a stock.
And you know, what we've just covered, just betting on a price to drop, that's really just the tip of the iceberg. More advanced traders, they might buy a put option on a stock they already own, kind of like an insurance policy against a market crash. Other folks might actually sell put options to generate a steady stream of income from collecting those premiums. It is an incredibly versatile tool.
So we're left with this final thought. Put options are a really powerful tool, and they're defined by two things: high leverage and high but defined risk. They give you the potential for these incredible returns, but also the very real possibility of losing everything you put in. Now that you know the fundamentals, the real question is this a tool you want to explore further in your own financial journey?